Hey everyone, Longacres Finance here, and today I will be going over the 5 highest yielding Dividend Aristocrats right now. If you don't know what the Dividend Aristocrats are, or if you'd like to know if the 5 highest yielding Aristocrats are worth adding into your portfolio right now, stay tuned. A Dividend Aristocrat is a company in the S&P 500 that has paid and increased its dividend for at least 25 consecutive years. They are considered elite dividend payers because a 25-year dividend growth streak isn't an easy feat to achieve. These noble stocks reward investors with steady and growing income regardless of what's going on in the stock market. The easiest way to get exposure to Dividend Aristocrats is through the ProShares ETF, ticker symbol NOBL. This exchange-traded fund lets you own a piece of each of the 65 current Dividend Aristocrats. However, not all investors will be pleased with the 2.69% dividend yield the ETF currently pays. The top 5 highest yielding Dividend Aristocrats all offer dividend yields of 5% or more. But are they a good addition to your portfolio right now? We are about to find out. Let's take a look at each of them and see what's going on with the business and what investors can expect in the future. We will start with the highest yield and work our way down. That makes AT&T the first Dividend Aristocrat we will look at today. The stock currently offers a monster dividend yield above 7%. AT&T has been growing their dividend for 36 years now. What an impressive streak from this telecom giant. The dividend growth, on the other hand, isn't anything to write home about. Since 2009, AT&T has been increasing their annual dividend by 4 cents per year. This equates to about 2% annual growth over the last decade. But for a stock that offers such a high dividend yield, this growth rate is very much expected. AT&T's current payout ratio is 66%, implying that there is enough room for them to continue paying their dividend in the future. 2020 was not a pretty year for the stock. They started the year trading near $40 per share and finished 25% lower, around $30 per share. Currently, they are trading just shy of $29, but on the bright side, new investors get a better entry point with a much more attractive dividend yield compared to last year. Revenues have grown at about 3.5% over the last decade, which is pretty fair. And AT&T has managed to maintain an operating margin around 15%. The company, however, carries a heavy long-term debt load of $153 billion right now. Management has brought it down a little bit from a high of $167 billion in 2018. But it is still a large burden for AT&T to deal with in the future. Don't worry though, AT&T maintains an ample amount of cash on hand to cover their dividend payments, and should continue their growth streak in the coming years. The stock currently trades at a low forward PE ratio of 9, compared to the S&P 500 that is around 40 right now. CFRA has a 12-month target price of $35 for the stock, and is projecting earnings to grow at a rate of 3% annually over the next 3 years. That target price implies a potential 20% price gain from AT&T, and a nice 7% yield on top of that. I think AT&T is a good buy right now, but I wouldn't expect much capital appreciation in the future. This is more of a cash cow that will provide a substantial high dividend stream. If you're enjoying the video, please smash that like button, and subscribe to the channel so you don't miss any future videos. Number 2 on the list is ExxonMobil, with a current dividend yield just shy of 7%. Exxon has not increased their dividend since June of 2019. So how are they still a Dividend Aristocrat? Well, the dividend growth for aristocrat status is measured by annual dividends paid out. Exxon paid a total dividend of $3.43 in 2019, and a total dividend of $3.48 in 2020. That is a 1.46% increase. However, to maintain their aristocrat status, Exxon must raise their dividend before the end of 2021. Prior to 2019, Exxon has averaged a dividend growth rate of 3.86% over the last 5 years, and 7.18% over the last 10 years. As you can see, that growth rate has been declining for a while now. 2020 was a rough year for the company. Total revenues fell by 29%, and the company lost about $22 billion during the year. This was a combination of the pandemic and the sluggish oil prices we saw last year. The stock price has bounced back from its recent lows in October of 2020, but still sits 38% below where it was 10 years ago. Long-term investors have not had a pretty ride with this oil giant. CFRA has a 12-month target price of $48 for Exxon, which is about $2 lower than its current price right now. While I personally think Exxon will maintain and possibly continue their dividend growth in the future, there is room for concern. Their balance sheet has taken a beating, and a dividend freeze or cut is not out of the question, if things don't get better soon. I know there is a trend for green energy right now, but I think the oil business will take a long time to be phased out. Going green is definitely the right decision, but the vast majority of the products we use are byproducts of oil, and I think it'll take a very long time for that to change. That gives Exxon a good window of time to shift their business model to green energy. Number 3 is another oil giant, Chevron, with a dividend yield just shy of 6%. Chevron has grown their dividend at a rate of about 6% over the last decade, and currently offers a very premium dividend yield. While back in March of 2020 you could have picked them up at an 8% dividend yield, the 6% they offer now is well above their historical yield of about 4%. Similar to Exxon, Chevron's revenues fell 32% in 2020, and they reported a net loss of about $5.5 billion for the year. But unlike Exxon, Chevron managed to raise their dividend last year by a whopping 8.4%. The stock currently trades around $92 per share, which is about 4% lower than 10 years ago. So this is another dead money investment aside from the generous dividend yield. CFRA has a 12-month target price of $88 for Chevron, which is about $4 lower compared to their current price. Much like Exxon, Chevron is negatively impacted by the price of oil and the shift to green energy, and this makes their future questionable. I don't expect to see a dividend freeze or a dividend cut from the company, but neither is out of the question. Like I stated before, there is still demand for oil, and that demand will not disappear anytime soon. So Chevron has room to bounce back and reposition themselves for the future. Number 4 is IBM, another stock that has not had the best decade. They currently offer a dividend yield slightly above 5%, and they've been growing that dividend at about 5% per year over the last 5 years. Total revenues have been declining at IBM over the last decade as the tech giant tries to reposition themselves to an ever-shifting industry. Operating margins have declined as well, but the company remains profitable, giving them breathing room to execute on their plans. They recently announced that they will spin off their Managed Infrastructure Services unit into a new company. Shareholders of IBM will receive shares of this new company after the spin-off. This spin-off will allow IBM to focus on their faster-growing artificial intelligence and cloud businesses. CFRA has a 12-month target price for IBM of $129, which is about 6.5% higher than its current price of about $121. I think IBM will continue to pay their dividend, and investors can expect modest growth. The spin-off may ignite growth for the company, although they've been trying and failing to do that for a few years now. And number 5 is ABBV, with a dividend yield of 5%. ABBV is the only stock on this list that has experienced capital appreciation during the last decade. Actually, they haven't even been around that long. ABBV is a spin-off company from Abbott Labs, and it was spun off in 2013. The stock price has almost tripled since then and currently trades around $104 per share. ABBV has double-digit dividend growth since its spin-off and retains an aristocrat status thanks to their parent company, Abbott Labs. Their payout ratio hovers around 50%, which leaves significant room for future dividend growth. ABBV has increased their revenue year over year since their spin-off. They have also maintained a solid operating margin of around 30%. The total debt on their balance sheet has been growing as ABBV continues to grow. This is something for investors to keep an eye on in the future. Their main product is Humira, which generates a substantial amount of revenue for ABBV. In 2019, Humira accounted for almost 58% of all of ABBV's revenue. The US patent on the drug is set to expire in 2023, while the European patent has already expired. While this doesn't mean Humira won't generate revenue going forward, but that income source will definitely be reduced as competitors introduce biosimilar drugs. ABBV does have a few promising drugs in their pipeline that can replace the future impact of losing the income stream from Humira. CFRA has a 12-month target price of $112 for ABBV. This is about 7.5% above ABBV's price today, which would not be a bad return coupled with their 5% dividend yield. Let's do a quick recap. Out of the top 5 highest yielding dividend aristocrats, I think AT&T and ABBV offer the best value right now. In addition to AT&T and ABBV, IBM also offers a rather safe dividend income. The two oil giants, Exxon and Chevron, offer very good yields, however I think their future is more questionable. If I had to rank these 5 stocks right now, I would rank AT&T as number 1, because of the super high dividend yield and the potential discount the stock trades for right now. ABBV would be number 2, because of the consistent growth of their business, which can offer the best capital appreciation in the future. They also have some promising drugs in their pipeline, and the most room to grow their dividend in the future. Number 3 would be IBM, because they have optimistic plans to shift their business to focus on faster growing sectors with the recently announced spin-off. However, IBM has failed to come through on past business restructuring plans, therefore they rank below AT&T and ABBV. Number 4 would be Chevron, simply because they continued to grow their dividend in 2020, reinforcing their commitment to continue their dividend growth. Aside from that factor, Chevron and Exxon are in a very similar boat and will have a rough road ahead as they try to adapt to a shifting industry. Both companies have a long history, strong management teams, and enough capital to survive and thrive in the future. The question is whether management will execute their plans and shift the business to benefit from industry shifts. That's it, guys. Let me know in the comments below if you like any of these Dividend Aristocrats right now. Thanks for watching. See you next time.